good morning, everybody. I'm Keith Bell, Sales Director at Evolution Funding, and I'll be a host for the next hour. We've just had what's probably been the most radical change in motor finance, certainly since I can remember, and I've been around a long time, as have a couple of these chaps. So when the new FCA rules on commission disclosure came into place on the 28th of January, and the idea behind this webinar really at the outset was just to get some early indicators as to what exactly is happening out there and how it's bedding in. So this morning, as you can see on the agenda, we're going to find out hopefully how the dealers have been adjusting to the changes, how the lenders are bedding in, which pricing models are working, which ones aren't, and also have a look at the important things like early signs on penetrations and how it's affecting income, which is of course important to all of us. And then we'll spend a bit of time discussing maybe what the FCA actually want and what's perhaps coming in the future. We've put a terrific panel together, as you can see, and you'll get the chance to question those in a session later on. If you just move your cursor on the screen, you'll see a little Q&A button at the bottom. Feel free to put your questions in. You can be anonymous if you wish to. Please, no questions about Nottingham Forest. A couple of the chaps are very sore at the moment, so I'd avoid that. We've also put together some great resource, including a brilliant dealer FCA health check, which I strongly urge you to get hold of. It's got lots of guidance and help about all the stuff we're going to talk about today. Very useful. And Sarah from our marketing department will be emailing those resources out to you later, and well worth the read. A lot of good stuff in there. But you can't get enough of a good thing, they say, or you can get too much of a good thing, perhaps. So we only got an hour today. So I won't waste any more time talking about Sunderland's heroic overcoming of the mighty Accrington last night, and we shall introduce the panel of our esteemed industry icons. I think I'll go for. I think that's the right level. And if I can just ask you, I know most people on who joined will probably know most of you, but if you can just take maybe 10 seconds to introduce yourselves, maybe starting with Joe, who is on mute. Fantastic.
It's such a good start, isn't it?
Okay, Joe, at least it wasn't me. That's
Look, they do that on daytime Good Morning TV in the morning as well, so I think I'm okay. But yeah. Hello and good morning. Yes, I'm Jo Davis, and I'm the partner and co-founder of Auxillias Ltd, and I'm a lawyer working in this industry for many, many years, first starting my career at Lombard. And yes, I'm really delighted to be here today.
Thank you, Joe. And Steve?
Hi, good morning all. Steve Rowe, I'm the Group F&I Director for Vertu Motors. Been with the group over 3.5 years. Previous to that, I was the F&I Director for Pendragon.
Thank you, Steve. Andrew?
Yeah, good morning all. Andrew Brameld, been Managing Director of BNP Paribas on the motor finance side for 4 years now. Previous to that with Barclays and also Lombard and First National.
Good. And Lee, finally.
Good morning, everybody. Lee Streets, CEO of Evolution Funding. Obviously, founded Evolution Funding after leaving First National Motor Finance in 2002, I think it was. Prior to that, I was with Wagon Finance as well.
Good, thank you, Lee. I feel obliged to say I was also at Barclays and First National and Wagon, old pennies and all that. So listen, I appreciate it's a really busy time. So genuinely, thank you very much for sparing the hour, everybody on the panel. Really appreciate it. Apart from you, Lee, you're the chief executive. You've got absolutely no choice but to join. So that doesn't apply to you. So I think we'll get things started off. So now we're pretty in a unique position at Evolution because doing what we do, we deal with thousands of individual dealers, lots of the dealer groups. We also, our technology also drives a lot of the customer journeys in the market, including the couple of big online retailers that have come to the fore this year. We sit behind them, and it's useful because we get quite a wide view of what's happening in the market. So I think to start with, it'd be great if Lee runs us through, takes the next few minutes just to run us through some early indicators from our perspective, Lee.
Okay, thank you, Keith. So yeah, as Keith already said, PS 20/8 came into effect on the 28th of January, effectively banning discretionary commission models in motor finance and also requiring us to strengthen disclosure requirements. So what we've got is 4 or 5 slides here just to take a quick look at how Evolution have implemented the changes and some indications as how those changes are performing. So let me attempt to move the slide on, which I failed to do. Try again. There we go. So in response to the discretionary commission ban, we've introduced 2 new prime pricing models. So these are just the models that we run in prime. One is fixed APR or fixed rate pricing. So that's a single APR for prime customers with no variable, no variable rate at all, based on parameters such as vehicle age or advance, although we do hope to introduce those in Q2. Credit score based pricing, so that's a varying APR based on the customer's credit score, which is unified across multiple prime lenders. As Keith's already said, we work with quite a lot of different introducers. So in January, we had to migrate over 2,500 dealer packages to one of these two options. And as you can see, at an aggregate level, 60% of our dealers chose fixed APRs or fixed rate pricing, and 40% credit score based pricing. Independent retailers narrowly have opted for credit score based pricing by 2%, and franchise dealers are heavily weighted towards fixed rate pricing at the moment. So what we've also done is looked at how each of these cohorts has performed in 3 key areas. Oh, gone too far. So these areas are average APR, average credit score, and average commission. And we've compared pre-PS20/8, so October through to January. So we were trying to avoid trying to do a like-for-like comparison, because obviously at the minute COVID is affecting quite a few different sort of comparisons. So we've tried to keep it to a short period. So the data that we're seeing, particularly on fixed rate pricing, is largely unchanged. There's been a moderate, very, very small increase in average APR by 0.02%, a 1% or 1 point drop in credit score, and a small increase in average commission. The credit score based pricing cohort has seen some more significant changes. So we've seen a drop of nearly 0.4% in the average APR across the cohort, but actually a 16-point increase in the average credit score with those dealers, customers, and a £42 per case increase in average commissions, which has been helped by an increase in the average advance, which has driven that up. So at the same time, obviously we had to make changes to our registry disclosures. So particularly in our checkout journey, our e-sign checkout journey. So we amended the Evolution Funding IDD, which is automatically sent to the customer with their e-sign link. We strengthened the message on both the existence and the nature of commissions. We now tell consumers that they can obtain the amount of commission on request. We even signpost them as to how they can do that through email or a telephone number to support that request. We've added 3 additional questions in our compliance journey within that checkout. So the consumer now confirms the retailer has given the IDD or disclosures. The consumer also confirms they've read the Evolution Funding IDD, and they also confirm they understand the existence and nature of commissions. So since we've made these changes, we've processed or paid out around 8,000 customers through this journey and made these notifications. And as a result of it, we've actually had 1 customer request to know what the commission was since the changes were made. What we've also done, if thought it was useful, is to get some early sentiment and feedback from some retail partners as to how they're viewing and seeing the changes. So here's a selection of them. I'm not going to read them all out, but what I will do is point out some of the common themes, words, and sentiment. And by a country mile, the biggest word used most often is transparency. The feeling that the new world is very transparent, and that actually it's very, very easy to deal with the customer now. The process has been sped up. The haggling and negotiations have been removed. There's also some sentiment that the ban has helpfully removed unnecessary discounting by some salespeople. And one group called out that whilst the process is more transparent, are consumers actually benefiting from lower rates yet? Finally, before I hand back to Keith for the panel discussion, I thought it was useful just to share some demand side trends that we're seeing. So the top 2 graphs on the screen are proposal demand. So the left-hand graph shows all proposals into the business, and the right-hand graph shows forecourt-based retailer demand. So in both cases, we're now seeing proposal demand as it's its highest since pre-COVID. The bottom 2 graphs look at paid out cases within the business. So again, on the left-hand side, it shows all paid out cases into the business. And on the right-hand side, it shows those from forecourt introduced retailers. So the takeaway on this is demand into the business at an aggregate level of all introducers has never been higher. It's higher than it was pre-COVID. And actually what we're seeing, despite lockdown 3 still in place, we're seeing independent, franchised and supermarkets returning to pre-COVID levels of demand. So into the context of today, it suggests that the industry has adapted well to the new change. So there we go, Keith.
Yeah, thank you. Just one question, Lee. You're doing a bit of a normal collier in the middle of that. That was very good, very interesting. Just one question before we move on. You mentioned that obviously we've seen an increase on the credit score-based pricing. We've seen a slightly reducing of the APR, but an increasing in income, and you suggest that might be down to balance. Where do we feel the penetrations are on credit score-based pricing and fixed rate? Is it too early to tell that, or have we got an indication of that?
We haven't got any data that could point to, credibly point to whether penetrations are increasing or decreasing. So all we can really take is retailer sentiment at the moment. And certainly on credit-based pricing, retailer sentiment is it's giving them more flexibility. It's giving them a rate they feel confident in offering to consumers, and that is driving additional finance sales.
Oh, interesting. Couple of questions, which just to let you, there will be a recording available of this afterwards, by the way. A couple of people have asked, and yes, all the slides will be available and data will be available, so that's fine. So Steve, from your perspective, obviously you see it from a slightly different angle. What's your sort of early thoughts, and what models were you running?
Well, interestingly enough, Keith, we actually running both. In our retail sector, we are running credit score-based pricing. But we do have one manufacturer that's actually insisted on remaining on fixed. Okay. So we're actually able to give a good correlation between the performance of the two, but also using a credit score-based system with our commercial vehicle customers. Again, it's not something we can do on a quick score-based approach at the moment. So we've actually got those on a fixed basis as well. I think it's interesting what Lee was saying about the increase on finance penetration and increase on earnings. We've certainly seen that from a credit score-based pricing at the moment. And I think the key word is definitely transparency. Yeah. It's delivered for us consumer confidence. In unique circumstances, I think we've got to be very careful in what we say now about the improvement or not of any model that anyone's going down. Because of the current climate we're in, we're dealing with different sort of customers. Yeah. And also, from an underwriter's point of view, which I'm sure Andrew will come on to, from a customer's credit score, what you can see and what has been affected by forbearance and furlough and the like, obviously gives a different impression on customers. But from a sales perspective, the fear factor that some salespeople may have had historically of going out with a high rate and negotiating down from an affordability point of view has gone. And that's delivered a much more confident approach from the sales team. From a customer point of view, it also gives the customer some trust in what they're getting. There's actually reality as to the rate they're getting now, rather than just what the customer looks like when they walk onto the forecourt or they're dealt with remotely on an omni-channel approach. So by having that transparency, which I think is certainly the buzzword at the moment for me, that has delivered us a great start. But when Scotland opens and then England opens, it'll be interesting to see how that evolves. But early signs for us are very positive.
It'll also be interesting when we get people actually in the showrooms again, and some kind
very
of
much so.
return, just how that dynamic between the salesperson and the customer and the business manager reacts as well. I mean, Andrew, obviously from a lender's perspective, again, a completely different angle. What's your early thoughts on it?
Yeah, very, very similar to the data that Lee presented. I think in the transition, I think it has gone reasonably smoothly. I think dealers have, in the main, understood the requirements. And for us, I think the packages were actually reasonably straightforward. So yes, there was a lot of work to get everything in place for the 28th. The vast majority of our dealers have gone on to a fixed rate. We are working with a number now on more risk-based pricing, and we're beginning to evolve into that space as well. But we want to do that very, very carefully, and certainly working with some key providers on that side of it. I think the one area that has probably got slightly more ambiguity that Joe might well touch on is around commission disclosures. again, in Lee's initial slides, I think he went through very, very clearly the way that Evolution have approached it. But certainly speaking to a number of dealers, it's getting that underlying level of consistency in what needs to be done, what needs to be said. And I'm not sure there's a particularly strong industry approach yet. I think it will come, but I think everyone on day one has either put wording in their agreements, where they've got POS providers, they've worked with them to try and get the wording right. But there's probably not as much consistency yet there. That needs to now evolve over time. But overall, I think given the timing that we've had since the changes went in, it's bedded down really, really well. And I think my only other sort of comment would be just on the income levels and everything else. I think there's two real schools of thought coming through. There's one backing up, I think, the data again that Lee showed, that actually the propensity for salespeople to discount rates has now been taken away, which has of course helped earnings. The other one is still over time now, which I think is where the FCA have certainly signposted. They want a more of a balanced share between the metal and the finance. So over time, will finance become lower and lower APR based pricing to move to more a retail-esque model of promotional credit to sell the vehicle, and more profit in other profit sources for dealerships. That will be a longer term burn, but certainly initially it doesn't seem that the earnings have reduced.
Oh, very interesting. And just before I come to yourself, Joe, Steve, a question just on that actually from an old friend of ours, Alex Watt. Just whether it's fixed rate or credit score based pricing, how's that in so far? It's difficult to know because I know you've not got people in the showrooms as such, but the lack of ability to discount, whilst the transparency is great, how has the customer has reacted to that so far?
I think you're going to have an element of customers. Morning, Alec. You can have an element of customers that are always going to feel like they want to get some form of discount.
Yeah.
But in the main, I think if you position the credit score based pricing right at the start, that this is relative to the customer themselves, what we've seen early signs is the majority of customers are more accepting that the indicative rate that we're quoting is on their personal circumstance. So there's always going to be an element then talking about affordability, and that way then obviously one of your major levers has gone, but that's still gone whether it's a fixed rate or whether it's a credit score based rate. So it then comes down to where you position the finance in the offer to the customer, and just really getting that education piece out early is really important to us, and it sets the scene.
And Julian King has asked on that as well, and then we'll just move to Joe to get her view from how the market's settling from her perspective. But how are you quoting customers? The question is how are customers reacting when you can't quote a rate initially without going through credit score based pricing? How do you run that?
We run a soft search.
Okay.
The soft search is done prior to any offer to the customer. Okay. That soft search is then agreed with all our partners that pulls as an algorithm through to an APR matches against a certain credit score,
okay.
which is all auditable by both our soft search provider and the finance company if they want to ensure that our guys haven't used that as a discount matrix.
Okay, so the customer actually knows the APR.
Very much so. It's very much transparent up front, Keith, yes.
I think that's it. That's a key part actually, because that's a really good question. Because for me, it's got to be held in the POS at the point of sale. So that customer, there's no point all customers being quoted 6.9, going to the lender, coming all the way back and saying, oh, sorry, because it places, of course, the salesperson in a very difficult situation around the monthly payment changing wildly, and is not a great customer experience. So I think to be really clear in the showroom with the customer as to what potential rate they could get is definitely, if you start this with the customer experience, it's got to be the best, the right way to
You have to, Andrew, because if you start actually talking about a guaranteed rate at the moment, there's too many variables. We're still reliant on the loan to value, and obviously a full search on the customer could find more detailed information. So it has to be, it's an indicative start. So it has to be transparent up front on that basis.
Interesting. So, Joe, from your perspective, obviously you're you deal with all sorts of different parts of the industry, and I know you have regular contact with the regulator as well. So how do you think it's bedding in, and what's the view, perhaps what's the first signs of the FCA's thoughts about how it's working, and can you see any gaps that's still missing perhaps?
I think we've probably been quite conservative in just choosing at this stage, isn't it, two types, the fixed rate pricing, and then looking at the credit score based pricing. And I think from the FCA's perspective, the credit score based pricing, it links to the affordability, which is one of the challenges we've always got to be mindful of, that the product's always affordable. And then also coming into this, vulnerable customers as well, and making sure that, we're checking that. I think that sort of mechanism as a model can work really well. And I think it's quite early days. And I think we've done so much online transactions as well. We've not had a lot of point of sale finance transactions yet to really get a feel for how is it really going for the customers. And I think it's just assessing, are the models working, and are we causing any unintended consequences, and is there any sort of consumer harm? And I think it's very early doors.
Yeah.
To check whether those outcomes are where we want them to be. The shift, if you are just on fixed pricing, and you're in the dealership, I can understand why, that might be why you sought to see these dealers coming back to the lender and saying, well, can I have another rate, please? Because they've only got one.
Yeah.
And of course they can't do that because it's been set. And it's making dealers understand that no, you can't, until your review period comes up again. That's when you get set the next rates, because otherwise we're introducing discretion. And what we don't want to get is this discretion creep, giving them more discretion, or creeping in.
Yeah, of course.
So that's the most important thing.
I'll preempt what I know the question is going to come, so I'll preempt it before anybody asks it. Is you mentioned a period of where your pricing is, it needs to remain stagnant, for want of a better term, before you change it again. How long is that period?
Well, look, in the FCA have never set that. They understand that there's going to need to be review periods that are set within the contractual relationships. Yeah. And we have September where they're going to be doing their first review. That's not far away. And if we have a look at the scale of that review, it's they're very transparent on what they're doing. And that is going to include some mystery shopping. So I think at that point, they are going to give us a good indication as to how these models are working. And it might well be that we want to change models after that, depending on what the regulator says. We need to check that the commission creep isn't there. Is there more commission being paid? And even though we've changed the models, we've still got to watch our pricing and the commission as well.
And just leading on to that, back to Steve, and it leads quite nicely into that, because obviously I know you're on the NFDA and you speak regularly to all the other big groups, and I mean, is there an appetite? What would you like to see more from lenders? It's interesting, Steve Reynolds, and if you think you're in a bad state as a Forest fan, Steve Reynolds supports Sheffield Wednesday, I know that, so he's in a world of pain. But he's saying, do you wish the lenders would come to something a bit more agreed, and maybe lobby the FLA to come with more of a standard commission disclosure document, maybe?
Yeah, morning, Steve. I think, one of the things we're trying to do within the NFDA and the FLA is work to get a consistent message in respect of commission disclosure. We did work with the FLA to try and get agreement on commission models. Yeah. We weren't able to align fully on that because we saw things slightly differently, but we are working with them on commission disclosure wording. I think that, I think it was Andrew mentioned earlier, that we've all put our line in the sand early doors, and we've all gone with what we think is the right approach. But I think over the coming months, I think they will get to a more consistent message, both through FLA and NFDA members. Yeah. We are working with Adrian and the team to try and get that. But there's a complexity in the models, whether you're a secondary broker like Evolution, or your prime broker like yourself. There's different models, there's different commissions, there's different things that people will have in respect to upfront commissions, stocking loans, other things that will trigger elements to a consumer that they would want to be disclosed to. So it's how you pull all that together when you've also got new car offers that are fixed, where you've got a credit profile pricing which is different on used. It really is how do you actually get that consistency. And I think going back to what Joe said, it is early days, but I do believe that both parties will work together to get that closer through the FLA.
I think that is really important. That's really
Mm.
important. And, you know, look, there are other models that are being piloted. You know, there was the rate corridor is being piloted, was to see how it fares, you know, particularly if you're only on a fixed rate model. And the regulator in their paper have been, you know, very clear that we were expecting you to set those models and just make sure that there's no discretion. And, you know, that ensuring that you get the right customer outcomes and they're not causing any harm. And I just think the two that we've set is just what we've decided at the moment. And, you know, that might move, that might change.
Also, Joe, they were the ones that technically the industry could probably deliver.
Yes, absolutely. And because of the monitoring, the level of monitoring that we need to do now and the data, you know, and, you know, look, we as a market, we're not as sophisticated as we would like to be in terms of the level of data we have to really monitor these closely. So if we just go with some models first and not have too many, it's just easier for us just to monitor that data, have a look what it's looking like, wait, you know, see what happens in the September review. And then we can decide again whether we want to shift things or how things change. But the most important thing is that while we're working with these models at this particular time, we're not going to have any discretion creep. So you can't, the dealers can't keep coming back to the lenders and saying, can I have more? Can I have this? Can I have that? Can I have that?
And just before I go back to Lee for a sort of a broker view, because we sit between all of the different parties. Andrew, from a lender's perspective, what's your thoughts on what Steve said? Just the lender's view. What, you know?
Yeah, I think there's two things. Just picking up on Joe's last point, actually, on this sort of creep coming in, because just on the packages point of view, you know, we are seeing dealers who have, of course, got probably stock that they're very keen to get rid of as the showrooms reopen on the 12th of April and are asking for a separate and distinct promotional rate. So they've got their fixed APR rates, but then for a batch of cars over here that they're very keen to get rid of, they might run a 0% campaign, etc., etc., which is fine, providing it's really clearly explained to the customer that this is the offer on these cars, this is the offer on those cars. But how you police that from a lender point of view becomes very, very difficult. Yes, the dealers are regulated in their own right, but we also as a lender need to have oversight of that as well, to make sure that there isn't cross pollination, if you like, between the two populations. So I think that creep is beginning to come in there, and is a challenge for lenders as to whether they're willing to go down that route. Which really is a key sort of part for us, considering it at the moment. And just on the commission disclosure part, following up on Steve's comment, for us, I think the FLA have done a pretty good job. I think they have provided wording, and to Steve Reynolds' question, they have provided wording, but it's now the interpretation of the dealers in the industry on, to be honest, where they put it in the journey. Some are saying it's fine to put it in the consumer credit agreement for the customer. Others are saying, well, almost that's after the horse has bolted. You need to be able to provide that, which is our view, for further when the customer is in the showroom, to make sure that customer is aware a commission could be payable. And the FLA have provided that wording on the various scenarios out to the lenders. But then it's the whole confusing technical area on, yes, do you update all of your POS providers? Because many of us are integrated into dealer systems, all the usual Ivendi's, Deal Tracks, Auto Converts, Evolution platforms, and is getting consistency from a technology point of view as an industry on how you do that, and that's going to take time.
It is, and that leads really nicely to the next going back to Lee, because clearly, if you think it's difficult for you, Andrew, we've got 34 lenders and about 20 technical partners to work with, so it's very good. So Lee, Ian Frankham's mentioned as one of the questions is just from a broker's perspective, how do you see the fact, you know, the changes on the commission changes affecting how a broker operates in the market?
Well, I mean, obviously you've got primary brokers and secondary brokers. I mean, the FCA recognising secondary brokers and giving secondary brokers the opportunity to continue to keep, discretionary commission sort of windows was a really, really positive decision by the FCA, and one that really means that we as secondary brokers can work with retailers and work with lenders to provide those commission models, to provide that flexibility, because often we've got the insight, we've got the data to be able to back that up and put the controls in place where lenders themselves potentially can't do that. We've got probably more agility in systems as well to build out reporting, to build out these controls. So I think, the broker, and particularly secondary broker, has got a really good, place to play in the market. And, I think overall, as a market, I think we should just view this as a great opportunity. We didn't ask for these changes. They were sort of forced upon us. But actually, and this is genuine, I believe it's a once in a generation opportunity for point of sale, to become a transparent and innovative and dynamic offering, to the market. We can deliver higher finance penetrations as a result. Yes, we've got to balance out retailer needs in terms of finance commissions and consumer needs in terms of outcomes, but I think we've got a major opportunity to do that. One of the key drivers in that has got to be further innovation in commission models, because one rate fits all is not a long-term solution. Credit score based pricing has a play. Further flexibility, as Andrew's mentioned, in campaigns, etc., has a role to play. And then I think the final bit for me is that there's a definitely, I like the adage that you get the regulator you deserve. And I think as an industry now, we've got a major opportunity to help shape how our regulatory environment looks in the years to come. But at the same time, we have to step up and we have to recognise some of the failings from previously. We have to make sure we deliver on those. We also have to look at some existing conc rules. And I think there's some rules that sit in conc at today's day that have perhaps not been looked at that heavily, that particularly now in a non-discretionary world, they come more into play. So some of the conc 2.5 rules, I think that's got retailers and secondary brokers and all brokers really need to look at how they do lender selection, how they design their panels. And we've all got to ask, are we designing our panels? Are we sending consumers to lenders? Whose best interest is that in? Is it the consumers or is it our own as the retailer? And if the answer is it's our own retailer, then we could be in some trouble.
I think that's a fair point, Lee. I think just on that, I think some of it isn't by design in respect of lender choice with manufacturers, and also innovation of certain partners having the product portfolio that we need. So I think there's definitely something on there. Just wanted to go back on also Andrew's point on the commission disclosure wording from the FLA. It is out there, but I think one of my frustrations I certainly feel is that lenders haven't actually delivered that consistently. And some of them have also gone outside of the FLA wording and actually interpreted it and changed it. So trying to deliver that from a dealer perspective, where you may have 3 or 4 lenders on your panel, and unfortunately not every customer gets accepted. Educating the customer with our own commission disclosure wording, and then lying over that 1 or 2 or 3 finance company wordings is a real challenge. And if you're a secondary broker, Lee, I'd be interested in how you actually deliver that as a secondary broker from a commission disclosure. If you've got, I think Keith alluded to 34 partners, how do you allay all those different commission disclosures on there?
Yeah, it's a good question.
I think,
Sorry, Keith,
Yeah, I mean, yeah, just if it'd be interesting to know, then, I mean, it's something we've had to work very hard at, but just for the people on the call, if you maybe give 10 to 15 seconds how we do approach that.
Well, obviously we've got 34 lenders on the panel, but not all of those are prime lenders. So I think the near prime, non-prime lenders have been largely unchanged by a lot of this. But for us, we have our disclosures. We obviously let the retailers do their disclosures. The existence and nature of commission is such now that we can't be prescriptive. We can't be prescriptive in describing the retailer's disclosures. So we don't do that, but we do ask the customer, did you get these disclosures at the point of sale? Did you get the ID from the retailer? And did you understand it? And I think that's the way to go for us. We're not going to try to preempt and read what the actual retailer's commission disclosures should be. I think also we've got to recognise, and this is partly my worry around only having one consumer ask for full commission disclosure, is every consumer is now getting an IDD from the retailer that, because of the nature and existence of commission, has doubled in size. They're getting one from us that's doubled in size. The lender is then adding to it as well. And our consumers just disengaging because they're getting too much information. I think that's probably something.
That's possibly.
Yeah, that's the confusion piece I mentioned, Lee. That's where my concern is, that there may be confusion out there.
Yeah.
And I think they're not getting through though as well. I think they're, from my dealer liaison, they're not feeling that they're getting a good enough understanding about what their disclosure statement should look like, because I think we've got to accept they are going to be different, because they are at point of sale, and they are going to be at the point where they then know what this particular lender I'm going to be moving forward with. I'm not going to say recommended, because I don't really think we should be going down to too much recommended. It's not something that I think we should be doing in this market. And I think that their disclosure statement is going to look different to the Evolution's statements. It's going to look different to the lender statements, and also they've got that pre-contractual disclosure area, haven't they? The early disclosure to do, and also then the point of scale. So whilst the FLA statements I think are helpful, I think where they're sort of getting to, where they look at them and they need to get them right, and there are shift and changes because they have to be able to disclose their model. And then also, Lee, when you're talking and then about this Conc 2 compliance around, well, I need to make sure as a dealer that I'm not looking at the personal gain. It's got to be in the best interest of the customer, of what I deliver, and the final commission models and everything that and the final lender that I recommend or give choices of, whichever route they're going down. They have to be in the situation where they are confident that it's in the customer's best interest and not in their personal gain. Yeah. And working with all of that as well around all the disclosures, not just about financially, they've got all the other factors and disclosure that they need to grapple with. It is quite a big area for them, and it can be quite daunting. And I do think there is a level of education that they still need and support that they definitely need.
So that's brilliant, Joe. Just before we go to the next stage, because time is absolutely flying. So before we go to the next stage with yourself, Joe, which I'm looking forward to getting your input on. A couple of questions from Noel Gormley and Rob Dobson, which sort of plays into something you'd said. You'd mentioned about commissions were, increasing commissions might be an issue, and I think there was a quote to Rob Dobson. I do remember this in the papers. They'd come up with some figure of 165 million too much commission being paid. I know how they came about that, but it's one of those press headlines. But do the FCA have a problem with that? Is part of the FCA's rule thinking is to try and drive down the amount of commission we're earning? Is the basic question from Noel and Rob.
I think it's all about whether or not they cause consumer harm. And if you've got the good level of disclosure, that you're doing all disclosures properly, yeah, and the rates versus discretion isn't going to cause the customer harm. Then that is, but what we got to be careful of is that when the FCA did do their review, they were feeling that, there was far too much monies being paid, and it was the consumer that was paying for it.
Yeah.
That if we have got, high levels of discretion, if now the new models are still creating customers paying more for their product, then changing the models and us putting in new models when then there may have been unintended consequences, and we may not be achieving the ultimate aim. And I think the September review will pick all of that up, won't it?
Brilliant. Well, thank you for that. That's the first panel sort of Q&A. That's fantastic. But there's more chance to ask questions. We've got plenty of questions coming in, and we'll come back to those shortly. But so obviously, Joe, in your position, a lot of the pre-webinar questions were what's coming next. What else do we need to be aware of? So, Joe, I'll hand over to you for the next 5 minutes, and you can perhaps run us through your thoughts of what we also need to be aware of.
Yeah, so thank you, Keith. So I think I just wanted to start with looking at the senior managers regime. And I know I've only got a really short space of time, and just a warning to all the dealers out there that, if you have got certified persons, then you have until the 31st of May to ensure that you file your Via Connect you make sure you file your statement around your certified person. So you may not have certified persons, but if you do, you need to be doing the certification with those key individuals, and therefore you need to be looking at making sure they've got that certificate in place. So you don't submit the fitness and propriety assessment to the FCA, but you do have to file via Connect before the 31st of March their form and application that you've completed that. So you provide the certificate to your certified person. If we just move to the next slide, would you be able to see from the next slide that the information that you need to be given via Connect is the directory of persons application is what it's called. And you'll see there that there's a list of information that I've put on the slide that you need to make sure that you file with the FCA via Connect before the 31st of March, and it's coming up. So I think that's the biggest thing that we really wanted to flag today. And of course, your training, all your certified staff need to be trained on the conduct rules by the 31st of March as well, and that is mandatory. And that's not just dealers, that's lenders as well. You know, if you are senior managers, got certified individuals, they should have all been trained on the new conduct rules as well. So that was really the main thing, Keith, that I was asked to cover today. I mean, of course, we've got the vulnerability guidance. We won't have got time to talk about that today.
No, indeed.
But and we've also got to other things to watch. But we maybe have time a little bit later to look at a few of the sort of things on the horizon. But that was my main thing. And on my next slide, just very quickly, there's a few areas on there which I'm not going to have time to cover. But if you just have a look at that in terms of making sure that it's not a tick box when you do certification, you do have to sit down and have a proper review with the certified people. And if there are performance areas, you do need to sort of work with those. So I just wanted to flag, and I'm not so sure how dealers are getting on with the senior managers regime, and I just think it's just important that they make sure they watch what they need to do, because it's really, really important.
Joe and Steve, I'm assuming you're all over the senior management regime, but I assure you, and all the dealers on the call, get hold of some of the resources that are coming out. Sarah, who's our marketing, who's you can see on the screen now, she'll be emailing those resources to everybody after this. Please take a look at it, Steve. I'm sure I don't need to mention it to you, do I?
No, we're okay.
The senior managers guidance that the Evolution have done is really very good, and you know, and I still think there's a little bit of a gap, but I think for some of the dealers, I think it's a really useful document. So yeah, have a look. Yeah,
indeed. So for the next few minutes, Joe, again, a lot of questions we had were actually a repeat of 2 or 3 questions that we get asked a lot at Evolution, and it covers half the questions that are sat in the Q&A now waiting, come to the next 3 conundrums. So if we can go to the first one. So what I'm going to do here is just describe 3 things that we get asked all the time, Joe, and in as shorter space as possible. Can we, what is your view on this as a I'm going to say as a regulatory expert? I think is that a fair statement to use? I think so. So scenario 1, Steve, I'm sure you've had this. I need a lower rate for this customer. So in this instance on the lending panel, you'll see these are all made up. The manufacturer independent, they've got a fixed rate. They've got 9.9. They don't have anything else available. Everybody gets 9.9. They both get paid the same commission at 9.9. But this customer does not want 9.9. They think they're better than that, and they want 6.9 or 7.9. So I suppose the conundrum on that one is, can I just go to somebody else, another lender, just for that one customer and get them a cheaper rate than my panel?
No, because if that is just your panel, you have to work with your panel. Okay. And if you had an additional person on the panel that gave a lower rate, then it would be right that you would talk to the customer about those options. Okay. Yeah, because we don't forget here, we've got to make sure we're treating customers fairly, not treating customers equally, but treating customers fairly. Yeah. And that's quite important. So that would be a no.
Just from Steve's perspective, Andrew's perspective, I know you both agree with that, of course. Steve, is that something you get asked a lot at your demo? Look, I don't want to flatter. I know credit score based pricing, but on the sites where you have the fixed rate,
you get it on both, Keith. You're bound to get it on both because you always can have a customer, especially if it's a repeat customer who wants to get a better deal.
Yeah.
But I also want to get into a size 32-inch waist jeans, but it ain't gonna happen. So, Sometimes you've just got to accept these things are what they are.
Indeed.
And he's just educating the guys. It's early doors. They're going to ask the questions. They're going to try and find what the boundaries are. And it's our job to educate and ensure we keep to the right compliant and regulatory stance.
Yeah, and just to remind everybody, a couple of questions again. Yes, all the slides will be available and all the recording will be available, so you don't need to worry about that. So we've gone to the next scenario 2.
Sorry, just on that one as well. I mean, if you set a dealer up with a fixed rate commission, then I totally agree with Joe as well. I mean, that's it. Otherwise, we're back to where we started and sleepwalking back into a rate corridor. So that's the whole purpose, I think, of what we've gone through.
Yes, indeed. It is. It's as you can imagine, it's something we get asked.
Yeah.
So scenario 2, slightly more complicated. We try to make it as simple as we can. So just bear for 1 second. So this particular, you might recognise this, Steve. This is not yours, but it's your style. Of, just to make it clear, it's not yours, but it's your style of setup. So clearly, we wouldn't win any business at those rates, obviously. But so these are purely examples. So the this particular deal has a lending panel that could be manufacturer or an independent, and they have 8.9% APR paying that. They've also got alongside that a second string. In this case, it's Evolution Funding, with various rates going up from there, paying different levels of commission. So 2 questions on this, Joe. First of all, if you've got a flat rate of 8.9 as your lead rate and a customer's declined, is it okay then for your next lender to have a higher APR?
Yeah, because all your customers here are treated the same, aren't they?
Mm-hmm.
So they all have the same opportunity to get accepted at that lower rate. And once they're declined, it's then fine for the next lender on your panel to be at a higher rate. Yeah?
Yes, good.
So then, yes, so I think that's compliant.
Okay, excellent. And the next question, if you look at the bottom,
just on that one.
Yes, go on, Andrew.
You're providing it's absolutely, and again, just going back to the key principle of this, that on the second string piece, that those rates are set by the lender. That's the big difference.
That's right. No, yeah, and so let's start that by everybody knowing from this point. Yes, this is already set. So this is on the. I'm presuming that when I'm being asked these questions, Keith, these are already set. So just
yes, they're all fixed. They're all fixed.
That's fine. This is the model dealers you must work with. Yeah, so that's absolutely fine. And the varying commission element, Keith.
Say again.
The variable commission.
Yeah, the next question was is at the bottom of, because I know there's been some talk about whether that's acceptable to pay a higher commission because the APR is higher, yes or no, so variable commission. So on the bottom left-hand side where you go to your second string, the APR increases and the dealer gets slightly more commission as the APR increases. Is that compliant?
Yeah, that's compliant because the increase in commission is really irrelevant here as long as all the customers follow the same process, yeah? And their rate is determined by that process. So the rate is the determining factor, isn't it here? Yeah.
Joe, just on that, do you think over time the FCA will start to, if you like, peel the onion a little bit more and say, well, okay, if you're paying, in this example, a higher commission at 8% on a 12.9, you need to justify the extra work involved in that higher rate case to justify the extra commission?
The extra work test, it's with the original model in Conc. It was there when we had the old models. So it's actually quite an old way of working because they were concerned at that point. So the current Conc rules isn't fitting for that. I think that there isn't any issue with you having a variable commission, provided that it's set by the lender. The lender gives that discretion.
Okay.
And and ultimately we need to be thinking about treating customers fairly. And the biggest challenge I think for the dealers is that it's not about personal gain, it's about best interest as well. And although this feels like everything's a race to the bottom, isn't it? That's not really what's intended. I think that is where we are, but it is about getting the customer in the best product. So there might be situations where there is a higher rate and with a higher commission, but the product is much better for the customer for some reason, and that just needs to be explained and disclosed. So we're going to have those situations in the market as well.
We are, and if we can just come to the third one, that's been very interesting. Yeah, these are the 3 most common ones that we ask. So.
Okay.
In scenario 3, just for the explanation for people watching, it's not as complicated as it looks. You have, again, same situation. You have 2 lenders. The first lender is a manufacturer and independent, fixed rate 8.9. Sat alongside that, though, you decided to go with a credit score based pricing with lender B. And actually those APRs, if you notice, the important thing to notice here that the lowest APR there is actually lower than your fixed rate with your main lender. So I suppose the question is on the right there, Joe, is can that work together compliantly? And if so, what have you got to be cautious of?
Yeah. So that would be compliant, as long as every customer is treated fairly and they've still got access to the same best rate available to them. That's the most important thing. But there are going to be some issues, isn't there? So if customers should have access to the lower 6.9 rate if they qualify.
Yeah.
And I think that's where you would use a soft searching, which Steve was talking about anyway, wouldn't you? You would soft search them first anyway. Yeah. To get the rate fitting to them. But also if lender B comes back at the 10.9% and then lender A comes back at 8.9%, yeah, then the customer still needs to be offered the better rate.
Yeah.
So or the better product that works for them is provided.
Yes, and our understanding of this one, Joe, is exactly what you just said. Plus, the only way really that can work is it would mean soft searching every single customer to make sure that you're getting the best rate for that customer.
Yeah, I think so. To be compliant, that soft searching mechanism, I think, is really, really important. Yeah. Because of course,
if you're not soft searching, I would suggest though you'd have to have your second lender if it's a decline from the first, and then you get soft search. I'd be uncomfortable having a soft search after I've done the first lend. Yeah, to give the customer a better deal. Yeah, because the question would.
A very good point, Steve.
That's a very good point. Yeah, it's right. And I think from the perspective here, I think the way we would answer that, we have this out in the market, but we say to the we will only put this in place if the dealer is soft searching every single customer, and that you make sure that if the customer is applicable to the 6.9 rate, then they get it.
Yes.
Would you do that, Steve? I mean, if you had dealers in the network that have got both of these availability, then just soft search.
Yeah, you'd soft search to make
sure.
Well,
so
why wouldn't you?
Even if you're going down that fixed rate, you'd still soft search, because if you've got both, it might well be that you need to come to that next layer.
Absolutely, because it may be if it's a PCP and the residual is different that suits the customer. Why would you not soft search first to make sure the customer gets the right deal? Definitely. I think your point on having that alongside the rate for risk model, or having that there, would only be useful if you've actually got the ability to soft search and choose the right thing for the customer. Because it might be 8.9 because the PCP is better than the 6.9 HP, because of that may get free servicing from the manufacturer and other products that you have to explain to the customer to let them make an informed.
Absolutely right. And I think here we are probably we're thinking about the rates, but you're absolutely right. They've still got to think about the product. What's the best product? And of course, there will be differentials between PCP and HP, and that is actually back to product suitability as well, because that's actually on the dealer's shoulders to get right as well, isn't it?
Yes.
What's the best product for the customer to start with? Yeah. Okay. It's good.
Very, very useful. Yes, it's something we come across a lot, all those questions. So I'm going to go out to some of the questions we've got coming in now. Just going back to SMCR, certified persons, Joe, and I think, again, it's anonymous, this one, is which individuals in a dealer group setup would fall into this?
Okay, so you may have all senior, you might have just had senior managers, because depending on the size of the dealership, actually, or the size of so it could well be that you haven't got certified individuals, but certified individuals are really the next management level that are making significant decisions about dealership, decisions about or have the ability from the senior managers to make decisions that could cause customer harm, and you would then look at certifying that sort of level of individuals.
Yeah. All I can say to that person is again, Sarah will email out all of our resources at the end, including a really good section on SMCR.
That's it. There's a good section in there about that. Yeah.
And I would urge you. And what's the deadline again? Sorry, Joe, I should know that off the top of my head.
31st of March to go via Connect and fill in for your certified. Yeah. Yeah.
And another question for you, Lee, if that's okay. The is just, are you, based on those soft search models and credit score based pricing, what sort of uptake are we seeing in terms of dealers using a soft search now? Because it's been talked about forever, but it's never really caught on. Is it now starting to become more common? Because obviously, Evolution provide a soft search facility. Are we seeing an increase in dealers doing that and soft searching every customer?
Yeah, I mean, the answer is yes. We're obviously, where we're running credit score based pricing, most of the retailers are using soft search. So they do that within our dealer's own system. We have a product called IQ, where they just put very basic information into the name and address, and that will trigger the searches, and it will trigger the customer's credit score, and in turn, obviously, the APR. So that's done very, very commonly now at the start of the journey before the customer gets quoted finance. We have partners that are using API calls for us and integrating that into their own user experience and customer journey. So, soft search is starting to move in the industry. It has to really. Credit score based pricing doesn't function really without it.
Mm. And Andrew, from a lender's perspective, obviously very, very few lenders use a soft search filter until you go down to the sort of lower echelons in the rate for risk area. Do you see the prime lenders going down that route eventually or not?
Yes, I think so. I think going back to the earlier conversation around risk-based pricing, you've got to do that now to have the right customer experience. So yes, I know certainly for our business, we are looking with our various point of sale providers now to make sure that we have that functionality as we roll out the risk-based pricing that we're looking at. So quite simply, yes, I think it's now become sort of mandatory to customer journey number one, but just to make sure from a finance business point of view as well, you're effective and efficient in your take up rates as well, because there's no point saying to all your customers, okay, you're 6.9, for them to come back at 19.9. Of course, your take up rates, your efficiencies in running a business will not be good. So you've got to be smarter than that.
Yeah. And interesting, a soft search doesn't guarantee a rate. Correct. So probably from Steve's perspective, how is that? How are you sort of managing that from your customer's perspective?
I think it's the same as fixed rates, really, Keith. If you're going with a rate to the consumer, you're giving an indicative of what the rate will be.
Yeah.
We then ensure that our second and third lend is the same rate. So we give ourselves two bites of the cherry at the same rate for the customer.
Yeah.
So where possible, you're hoping to place that business. As we get more technical and get better understanding of the scoring systems, trying to get 26 lenders to agree a rate matrix on that basis has been like herding cats, but we got there. So if we need to move one area, it needs to move for all the lenders. So it's one of those points that it's an indicative for the customer, and hopefully we get them placed. It's no different for me if it's a max advance. From a loan to value perspective, there's always going to be something that may affect, that from an underwriter's point of view, not just the car or just the customer. It's a combined of both. And then you've got the affordability checks on top of that as well.
Yeah, so with this time is rapid, so I'm just going to finish one more question. Very briefly, Andrew and Lee, how are lenders and finance brokers going to deal with dealers who are found not to have proper processes in place?
I'll go firstly. I think quite simply, of course, we want to work with our dealers, and we've had a lot of great communication with our dealers, and it's been remotely because of lockdowns and the pandemic, of course, which makes life slightly more challenging. But I think we've had quite regular contact with them, and we want to work with them. We help them with the frameworks and the processes to go around it. Ultimately, if through our sort of auditing and everything else, we are unhappy that they are then applying them, then of course we will move away from those dealers. We've got to deal as a mainstream bank with people that we're comfortable with, the right partnerships for us as a business. So we'll do everything we can to work with dealers.
Lee, it's got to be very brief, I'm afraid, because we're almost out of time, but I'm assuming the answer is the same, is it?
No, Keith, slightly different. We work as a secondary broker. We work with a lot of retailers, but do a small amount of transactions with them. So what we have to do is build systems and controls that don't allow the retailers to make mistakes. So the system will quote what they're allowed to quote, and it won't quote anything else. And so that's the key thing for us, trying to put the right systems and controls in place to stop any retailer errors.
Yeah, and that's to our business, that's vital. That's, you know, to get trust within the partners that we deal with. So that's good. Unfortunately, that's the end. There's lots of other questions coming in. We will get answers out to everybody. That has been the quickest hour I've spent for a long time. So I just want to say thank you to all the panel. It's been really interesting. I hope everybody's really enjoyed it. I've learned actually quite more than I'd expected, to be fair. Else is the same. Thank you very much for your time. Just to remind everybody, we have got resources available. They will be emailed out after this webinar. A recording is available if you want to watch the recording as well. Thank you to Sarah, who's sat there patiently, put a lot of work, an incredible amount of work to put these things together. It's not as straightforward as you four have made it look today. Trust me, it's very difficult. So thank you again. Thank you for joining, and listen, everybody have an absolutely fantastic day. Thank you.
Thank you.
Thank you.
Thank you.